This is Standard Costs and Variances, Chapter 11. Standard costs are benchmarks, or what we consider norms when we're measuring performance. In managerial accounting, there are two types of standards that are commonly used: quantity standards and price standards. For example, a quantity standard is if we used 3 pounds of raw materials to manufacture that product, then that would be our standard. And then if we had a price standard, let's just say that raw material normally costs $2 per pound. So therefore we have a price standard as well. Deviations from standards deemed significant are brought to the attention of management. This is a practice known as management by exception. So, all right, direct labor was below our standard cost, direct material was significantly above, and manufacturing overhead was near the standard cost. So we would want to talk about, why is direct material off? Well, if we used more than 3 pounds, it might be off because of that, which would be a quantity variance. Or if it costs $4 instead of $2 per pound, that would be a price variance. So how a variance analysis cycle works: prepare standard cost performance report. Then you analyze the variance. You identify questions and you ask those, and then you receive explanations and take corrective action and conduct next period's operations, and then you begin again. So you're constantly going to do this variance cycle to see, are we on budget, are we on plan, are we where we think we should be, are we off, and why. Setting standards. Should standards use ideal standards that require employees to work 100% peak efficiency? No, I would say you want to use a practical standard that's currently obtainable within reasonable efficiency and effort. So when you're setting direct material standard, you need a standard price per unit, final delivered cost of all materials, net discounts. So we can't get a price without actually shipping if we have to ship that product to us. And then a standard quantity per unit. We need to summarize it in a bill of materials. So how many of those should we normally be using when we're manufacturing this item? Setting direct labor standards. So what do we normally pay per hour? Often a single rate is used that will reflect a mix of wages. We would want to, let's just say there's different pay scales within the manufacturing that have part of direct labor. We would want to take an average of that so that we had a more accurate wage, and it would be one standard rate per hour. And then standard hours. This uses time and motion studies for each labor operation. So how long in my tax returns, like how long would a simple tax return take me? Let's say it's a half hour. Well, if something takes me more than that, I need to figure out why. So that's why you would have standard hours per unit. So when you're setting variable manufacturer overhead standards, the price standard is the variable portion of the predetermined overhead. And then the quantity is the quantity of the activity that was used for the predetermined overhead. That could be direct labor hours, that could be manufacturing hours, machine hours, as we've talked about in previous chapters. Using standards in flex budget. So, standard cost per unit for direct materials, direct labor, and manufacturing overhead can be used to compute activity and spending variances. Spending variances become more useful by breaking them down into whether or not they're quantity, which means we use too much or too little of the quantity, and we're off on that, or a price. It costs too much or too little compared to our standard. A general model for price variance is you have variance analysis, then you have quantity variance. This is materials quantity that vary. Then there's labor that varies. And then there's manufacturing overhead. So notice that materials is a quantity variance and labor and overhead is efficiency variance, because this is related to people doing something. And then we have price variance. There's material price variance, labor rate variance, and manufacturing overhead variance. So how we figure variance analysis. The very first thing we do is we take our standard quantity allowed for actual output times the standard price. So standard quantity times standard price. And then we take number 2, actual quantity of the input. So not how much we thought we were going to have, but how much we actually had in quantity times our standard price. Then in the price variance, we will also need actual quantity times actual price. The quantity variance is actual quantity times standard price minus standard quantity times actual times standard price. This will make more sense when we play this out. So a standard quantity is the quantity allowed for the actual output of the period. Actual price is the amount you actually paid for an input used. And standard price is the amount that should have been paid. So if we thought it was going to be $2, that's standard price. The actual was $4. We'll do some examples about this. Computing direct material quantity and price variance. So here's an example. Glacier Peak Outfitters have the following direct material standard for fiber fill in its mountain parka. 0.1 kilogram of fiber fill per parka is $5 per kilogram. Last month, 210 kilograms of fiber fill were purchased and used to make 2,000 parkas. The material cost was $1,029. Okay, so if our standard quantity is 200 kilograms times 5, we would have $1,000 as our standard. But we actually used 10 more times our standard price of 5. That would have given us a price of $1,050. But now we used more, but we paid less, so we had $1,029 as our actual. We take the quantity variance, standard minus actual. It's an unfavorable $50 variance in quantity, but we had a favorable price variance. This total will be our spending variance. Negative 50 plus 21. So this is how this equation really looks. Materials quantity variance, or MQV, equals actual quantity times standard price minus standard quantity times standard price. A materials price variance, or MPV, equals actual quantity times actual price minus actual quantity times standard price. What we're doing here is isolating price in this situation and quantity in the top situation to figure out what part of this total spending variance was made up because we had a price problem or situation, or was it made up because we had a quantity or efficiency problem? Responsibility for the materials variance. So there's a materials quantity variance. That would be the production manager. So they're the person in charge of producing the product, or the people that produce the product. So he would have, the production manager, he or she, would have an ability to control what's happening on the production floor. But they really don't really have an opportunity to control price. Price is controlled by the purchasing manager in most manufacturing settings. The standard price used to compute the quantity variance so that the production manager is not held responsible for things that are really the purchasing manager's fault. Here's what they're saying when they call each other. I am not responsible for this unfavorable material quantities variance. You purchased cheap materials, so my people had to use more of it. And the purchasing manager, well, your poor scheduling sometimes requires me to rush materials at a higher price, causing an unfavorable price variance. You can see how this could get ugly quickly. So now let's talk about, that was materials variance. Let's talk about labor variance. Now at the same manufacturing for the parkas, Glacier Peak Outfitters has the following direct labor standard for its mountain parka. 1.2 standard hours per parka at $10 per hour. Last month, employees actually worked 2,500 hours and total cost of labor was $26,250 to make 2,000 parkas. Now we're going to calculate a rate variance and an efficiency variance. So standard was 2,400 hours at $10. Actual was 2,500 at the standard price of $10. So we had $1,000 unfavorable efficiency variance. Now let's go to a rate variance. We had 2,500 hours actual and we had a rate of $10.50. So we had a rate variance of $1,250 for a total unfavorable variance of $2,250. So 1.2 hours per parka times 2,000 parkas would have been 2,400 hours. That's how we came up with 2,400 hours. And then for the rate, the total was 26,250, and we had 2,500 hours actual. So that's how we came up with the actual hour, $10.50 per hour. So here are some equations for labor variances. So labor efficiency variance equals actual hours times standard rate minus standard hours times standard rate. The labor rate variance, or LRV, equals actual hours times actual rate minus actual hours times standard rate. Again, we're isolating rate in this situation and number of hours in this situation. Who's responsible for these labor variances? Production managers are usually held accountable for labor variances because they can influence them. So what could they have done differently? Well, the mix of the skill levels assigned to the work tasks, the level of employee motivation, the quality of production supervision, and the quality of training provided to the people could all influence labor variances. So here's the purchasing manager and the production manager arguing again. I am not responsible for this unfavorable labor efficiency variance. You purchased cheap materials, so it took more time to process. I think it took more time to process the materials because the maintenance department has poorly maintained the equipment. Passing the buck. Now we go to variable manufacturing overhead. They had the following direct variable manufacturing overhead standard for the mountain parka. 1.2 standard hours per parker at $4 per hour. Last month the employees actually worked. Now this is measured on direct labor hours, right? 2,500 hours to make 2,000 parkers. Actual variable manufacturing overhead for the month was 10,500. We're going to isolate efficiency and rate variance. So the 2,400 hours we should have worked at $4 should have been 9,600. We actually worked 25 hours at the standard price would have been 10,000. So we have an unfavorable efficiency variance by 400. And to figure out the rate variance, we have 2,500 hours at $4.20. So we have an unfavorable rate variance for a total variance of $900 unfavorable. Again, we did the same thing to calculate the number of hours. 1.2 hours per parka, and we had a standard of 2,000 parkas. And we took the total cost and divided by the 2,500 hours that we actually had, and that gives us $4.20 as a rate. Variable manufacturing overhead variances. So for efficiency variance, it's actual hours times standard rate minus standard hours times standard rate. So variable manufacturing overhead is standard rate, actual hours times actual rate minus actual hours minus standard rate. Variance analysis and management by exception. How do I know which variances to investigate? Larger variances in dollar amounts or percentages, if they are standard, are investigated first. The bigger the variance, the quicker you need to investigate. Advantages of standard costs. First of all, it gives you management by exception. It has simplified bookkeeping. It enhances accountability, and it promotes economy and efficiency. It could be a negative impact on morale. Favorable variances may be misrepresented. Emphasizing standards may exclude other important objectives. Standard cost reports may not be timely. invalid assumptions about the relationship between labor cost and output. And then continuous improvement may be more important than meeting certain standards. We're going to do some actual exercises in this chapter. That will be a separate video.